Is a US recession coming? What's happening? Regardless of what markets you're trading, you have to remember what happens in the US will affect your market as well. So check this video out. Hey guys, so let's talk about the markets. Let's talk about the US economy. If you're new to this, I'm Marvin Germo. I'm a Filipino stock market trader, investor, author, and my passion is sharing information that will help you to win in investing regardless of where you are in life, because I really believe that investing, particularly the stock market, is one of the greatest tools that can help you reach your goals of financial freedom. And that's what I always say. Investing is all about freedom. It's not about money. It's you living your life at your own terms. So if you're new to this channel, subscribe. I create videos daily as much as I can to help you, to educate you, because I really believe this. In the world of investing, it's all about information. It's all about processing the right information to help you win, because you knowing detailed information that will help you decide properly will spell the difference between making money and losing money. And I want you to win. This channel is dedicated to help you win repeatedly, not just now, but repeatedly for the long term. Because at the end of the day, this is one of the greatest times to be an investor. This is one of the greatest times to be alive. This is one of the greatest times where wherever you are, you can win and you can make your money work hard for you. So let's begin. No? Before that, also, what I would like to share is this: basically, investing and talking about recessions. This is not the sexiest of the topics that are out there. No, this is not something that a lot of people want to talk about. This is not something that people are excited to talk about. But I'm not saying this out to make people scared. I'm not saying this to frighten people, because I for one, I'm an optimist. I like to see the best out of things. But you have to remember, preparation time is never wasted time. The more you prepare today, the better you will be in the future, and so that you get to know and you get to make this informed decisions based on what's happening in the market. So regardless of where you are, regardless of what market you are trading or investing, what happens in the US will greatly affect what's happening in the Philippines, in Asia, in Singapore, because the US still is the largest economy in the world. And you have to remember, 2008, the markets crashed. You saw the market start to reverse 2007, then which led to the recession in 2008. So when markets crashed, it was pretty much triggered also by what happened in the United States of America. So I'm not saying this to breed fear to people. I know the heart of this. The heart of this is just to help you be educated for you to make the right decisions. So just a couple of things before I go to the meat of the topic. Number one is basically this. Recessions are cyclical, meaning it's not a question whether recessions will happen. It's only a question of when. The goal and the narrative of this is, you have to understand, if you're an entrepreneur, you are an investor, you have to understand that recessions will happen at a certain point in time. It's not a question of if it will happen or not. It's only a question of when. And the more you prepare for it, the more you create scenarios where you win, is what will allow you to make money repeatedly over the long term. People always talk about 2008 as one of the grimmest times out there, but you have to understand this. In the grimmest of times, that's where a lot of multimillionaires were made. That's where a lot of multimillionaires came out as well. And knowing this, should it happen, you come out prepared also. Number two is this. No one has a crystal ball. Guess what? Even the best analysts, we're not fortune tellers. Stock traders, investors, brokers, fund managers, accountants, economists, we're not fortune tellers. No one knows what interest rates will be 5, 10, 20 years from now. No one knows where the stock market will be 5, 10, 20, 30, 40, 50, 60, 70, 80 years from now. No one knows where the markets will be. So whenever you hear a forecast, whenever you hear a prediction, take it with a grain of salt. At the end of the day, you will win when you decide on your own. You will win when you buy based on value. You will win when you buy based on what the charts are telling you and what it has been dictating. But here's the thing, though. I want to zero in on the fact that the market has been massively, massively, massively up already for years, and you have to understand this. Markets cannot go up forever. Markets they won't stay up for a very, 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 very long time. There will come a point in time where people will have to sell and they will have to take profits. Looking at this chart here, you will see that the Dow Jones Industrial Average from 2009, over a decade ago, has already moved up almost 300 plus percent already, meaning those who came in and at those periods are making immense amounts of money, so they can sell anytime, take profits anytime, and still have a large margin. And this is just the index. You have to understand, in some individual stocks inside the index have done a better job than the index per se. So when people start taking profits, when people start selling, regardless of what the reasons are, regardless of what the rationales are, markets will just drop, and it will not go up forever. And people have been saying that markets in a 10-year periods have been dropping, and we've been in an extended period already of long market movements upward, and this will not last. You have to remember this. I don't want a crash to happen, but it's inevitable. Eh. History and time will always tell you that over a span of 10 years, markets do crash, markets drop. Things like this are normal. If you don't want to get hit by this, you don't have to go and invest in the markets. But for those of us who want to uh, who who want to live through this is exciting times as well, because I believe that as you grow and as you trade scenarios like this, it also builds not just your portfolio, but it also builds your skill and experience. And it's that skill and experience that will help you and bring you towards financial freedom. So the main meat of this, people are scared because of the yield curve inversion. What does that mean? It means that short-term bond rates are now higher than long-term bond rates, because normally long-term bond rates should be higher than short-term ones because of the risk and the uncertainty that are placed from the length of time that you are investing. But the fact of the matter is, something happened just a few days ago, which made the yield curve shift and invert. The short-term yields now, particularly the 3-month yields, are of better yield than the 10-year bond. So, based on analysis, based on history, uh, every time a yield curve would invert, it would always lead to a recession. And this has happened since the 1950s. This happened in 2006, 2007. This happened so many times in the past. This does not answer though when it will happen, but it's telling you already that it's a precursor to something. The reason why yields go up over the short term is that a lot of people are pegging that it's this scenario where we are right now is much riskier than probably the foreseeable future that's longer, and we don't know what will possibly happen. So we don't know if it will happen in 2019. We don't know what will be the trigger, what will be the cost. In 2008, it was the subprime mortgage that caused a lot of defaults to happen, and then those people buying derivatives off of that. For 2019, we don't know what the trigger will be, but this is like an early warning shot. This is an early signal. So for those who have cash right now, for those who are positioned right now, at least this is a warning shot for you, at least to be cautious from where we are right now. Now, above and beyond that, now, should it happen, and a lot of people have been pegging on this already, one of the reasons that this could possibly happen, one of the bigger defaults that could possibly happen that could lead to a larger recession, I really believe it's student loans. Please remember this: student loans are now 1.56 trillion US dollars, and 44.7 million Americans out of the 300 plus million Americans are in debt, and 11.5% of them who have the loans are not paying over 90 days already. They're in default. So imagine the magnitude of this and how big this will impact the financial system of the United States of America. So should it happen, I'm not saying it will happen this year. What I'm saying is, this is a early warning shot. This is something that should cause you to be a bit cautious in the way you would proceed in your investing. It's something that wherever you are, it should be something that would push you to be able to at least somehow, some way decide on your course of action as well. So there. Before I proceed, I just wanted to invite you, for those especially from Manila or the Philippines or wherever you are in the world and you want to learn more about the markets, my next set of sessions will be in Cebu, April 6 and 7, Singapore, 18 and 19. Then the largest conference in the Philippines, Icon Investment Conference, will be in May 25. Then Manila, Iloilo, Cagayan de Oro, Hong Kong, UAE, Qatar, and Taiwan will be on the second half of the year. So if you're interested about investing, winning in the markets, I hope to see you there. Now, let's look at the charts now. You know me, my style, my narrative is the chart discounts everything. So as long as the charts tell me that it's still bullish, that the market is still not showing us that it's still in a downtrend, you can still hold it. Because my goal is, I never try to forecast. I never try to. I don't try to guess. I just take the charts as it is. So what we're seeing in the yield curve inversion is something that's negative, but let's see what the charts are telling us. So this is the S&P 500. This is one of the indices that a lot of people around the world are watching. The 500 biggest companies in the world. So there's one thing that I do know. Last Friday showed us a large red candle, a large bearish candle, which brought the stock down to the 200-day moving average, which for all intents and purposes is also a support range. However, if this does not hold, guys, I believe it can go to the 2755 mark, which is a strong support. Now let's see if this will hold, because if this does not hold, we may be in a tougher time. This may lead to larger selling as well. With that, also from a shorter perspective, this upward progression has also been broken. So you have to really watch out for this 2755 level. So if this holds, probably the longer downward movement may not happen yet. Even MACD is still bullish as of this point in time. It's still above the zero line crossing. So as of this point, one thing that traders, investors should watch out for the S&P 500 is a 2755 level. If it bounces and holds this level, we're still pretty much good. But if it doesn't, there could be a drop to 2627, and then a large main support will be 2347, which is still a great way off now from where we are today. Then let's just look at also the Dow Jones. Just to give you another perspective on what's happening as well. So there. So if you look at it, also it's the Dow Jones hit a large red candle as well. Main support also is a 200-day moving average here at the 25,163 mark. So let's see if this gets breached. At the end of the day, the market has already been sideways since Feb this year. We're seeing indicators showing us also change in direction, but it's primarily showing us that it's sideways. If this does not hold, the market could drop further to around the 2,300 level. So let's see how it goes, if it actually dips as well. If the 23,388 level does not hold, the market could drop down to 21,782 for the short term, or 21,700 levels for the short term. So those are the levels for the Dow Jones. For the Filipinos following me, this is where the index is right now. One of the reasons why it's down, it's also pretty much triggered by the news. Now, the market in the PSEI is also sideways, but the large red candle was brought about by it failing and having a hard time breaking out from the 8,100 level. What saved it though today was this large red candle. It hit the 20-day moving average, which, as you all know, those who follow the Stock Smart sessions, it works as a support range. If it holds this level, I believe that if it holds this level, instead of it falling further, it could possibly bounce. But if in the next few days this 7,800 level does not hold, the market could just shift and go back down to the 7,500 level. So with that, what should you do as a trader, as an investor? Again, this is not something to make you fearful, but I hope this is something that will help you make the right decision. Technicals are showing us that there's a large red candle. S&P 500, Dow Jones, and the Philippine Stock Exchange Index, but it has to, as long as the 200-day moving average will hold, we're still in a sideways motion of the market. So there's nothing to be fearful from a tech perspective as of this point in time. And if you look at all of the other figures, everything else fundamentally is still doing well. So again, this is just a warning shot. But for those that want to prepare, number one, just hedge. You can buy different assets. I've been a big fan of gold over the past few years because gold is a hedge. It's this is not, gold should not be your first investment. It should be on top of the other investments that you have. If you have excess, it could be a good hedge to the markets, but it's not a primary investment that I would encourage you to get if you don't have any investments yet, because it does not give you any dividends, and it only will work well if times are bad. But what if though, if bad times don't actually happen? Number two, as long as you're investing excess cash, you're supposed to be okay. Only invest money that you don't plan to touch 5, 10, 15, 20, 30 years from now. The longer the time frame, the better, because the arbitrage for investing in the market really is all about winning and looking at the longer duration. You're not just supposed to think about the day. People get rich not just thinking short-sighted. Think about where you will be over the long term. It's not about get rich quick. It's about getting rich, and getting rich quick is being slow. You have to love the process. That's why you have to put excess money, money that you're not willing to touch for a very, very long period of time, money that's not for your children's enrollment, money that you won't use for your wedding next year. It always has to be excess cash. Never put your emergency fund in the stock market. That being said, try to find ways right now to build and stockpile cash. Try to build and find ways on how you could build cash. Why? That's why I have a just in case of emergency fund, just in case of recession fund. Why? So, should recessions happen, I can pull that cash and buy the cheapest stock out there, because it's not a question whether a recession will happen. It's a question of when it happens, are you prepared? Do you have the cash to win? Do you have the cash to help you make money over the long term? So that's it for now. I hope this is something that encouraged you in spite of negative data. I hope this is something still that will cause you to invest, because at the end of the day, if you know what you're doing, if you're investing properly, you will win. And the goal of and the heart of this video is to help you be educated that should we go into bad times, I'm still gonna be here with you. I'm gonna make these videos. We're gonna document this together. We're gonna go through this together. If it doesn't drop, it's okay. The winners of all of this are those who know how to select stocks well and know how to position. So that's it for now. This is Marvin Germo. I hope this video helps you trade well, trade strong, trade smart. See you all again soon, guys, and bye bye.